Today, winter is coming. Market update for the 29th of September 2021. Hello again, it's Martin North from Digital Finance Analytics, World Latest posts covering finance and property news with a distinctively Australian flavour. In today's show, we look at the latest market falls and what's driving them, why Blackrock is buying back into China now, the emerging energy crisis, and what the Council of Financial Regulators said about Macro-Prudential controls in the Australian mortgage market after the Treasurer's outing yesterday. And here is a clue. Crickets. And just remember, as I've been underscoring, September and October is the time of year markets tend to correct at the best of times, and we are far from the best of times just now. Wall Street stocks ended sharply lower on Tuesday in a broad sell-off driven by rising US Treasury yields, deepening concerns about persistent inflation, and contentious debt ceiling negotiations in Washington. All three major US stock indices slid nearly 2% or more, with interest rate-sensitive tech and tech-adjacent stocks weighing heaviest as investors lost their risk appetite. The Dow Jones Industrial Average fell 1.63% to 34,299. The S&P 500 lost 2.04% to 4,352, and the Nasdaq Composite dropped 2.83% to 14,546. In fact, it was the S&P 500 index's biggest one-day percentage drop since May and the Nasdaq's largest since March. The S&P 500 and the Nasdaq Composite Index were on track for their largest monthly declines since September 2020. Half of the S&P 500 components closed 10% or more below their 52-week highs, and that includes 63 stocks that have fallen 20% or more. The many supply and demand imbalances, including new production constraints stemming from the pandemic and supply problems, could make inflation surge more than anticipated, one analyst said in the note. The big picture is the sudden surge in the past week of yields, which has led to a sell first, ask questions later mentality, Ryan Detrick, senior market strategist at LPL Financial, said. But there are multiple factors weighing on sentiment today, he added. The back and forth in Washington with the debt ceiling and the spending bill and the potential higher taxes have weighed on overall investor psyche and has led to a pretty good-sized sell-off. However, some believe it may be too early to worry about a sooner rather than later lift in rates, at a time when the Federal Reserve's balance sheet shows there remains ample liquidity. I don't think we've got enough data to suggest the Fed will lift rates soon. Mike Skillman, who's CEO of Faith Investor Services, said the US Central Bank is going to be cautious on rate hikes until it's very clear that inflation will be longer and more problematic than they believe it is today. But the US 10-year Treasury yield topped 1.5%, surging to its highest level since June, as investors fretted about the prospect of the Federal Reserve raising interest rates sooner than expected to control inflation. In fact, Treasury Secretary Janet Yellen said she expected inflation to near 4% by the end of 2021. And she's actually repeatedly stepped into the fray. She has made direct appeals to lawmakers, and late last week she called on leaders of Wall Street's largest financial firms, including JP Chase and Citigroup, to help pressure Republicans to act. It is imperative that Congress swiftly address the debt limit. If it does not, America would default for the first time in history. The full faith and credit of the United States would be impacted, and our country would likely face a financial crisis and economic recession. Senate Republicans blocked a bill that would suspend the debt ceiling into December 2022 and keep the government operating past September the 30th, forcing Democrats to find a new strategy to address two fast-approaching deadlines with acute economic consequences. The 48-50 largely party-line vote fell well short of the 60 needed to advance the House-passed legislation to the floor. Republicans would let the country default for the first time in history, Senate Majority Leader Chuck Schumer said after the vote. It's one of the most reckless, one of the most irresponsible votes I've seen in the Senate. Schumer switched his vote to no at the last moment, which allows him to call up the bill for another vote later. But he gave no indication of any further strategy to prevent a government shutdown early on Friday and a default on government obligations sometime in October. Republicans refused to back the debt ceiling suspension because they say they don't approve of Democrats' plans to spend trillions as part of President Joe Biden's far-reaching economic plan, even though a major portion of the current debt accumulated under Republican control of Congress and the White House. That's a departure from the usual bipartisan votes on the debt ceiling. That said, so far financial markets don't seem particularly worried about a potential US default. Investors are demanding only slightly higher interest rates on Treasury bills due in late October and early November, the period considered at risk for delayed payments. But on the economic front, consumer confidence fell well short of investor expectations as the impact of the Delta variant weighed on sentiment. The Conference Board Consumer Confidence Index fell unexpectedly to a reading of 109.3 from 115.2, missing economists' estimates of 115. Consumer confidence dropped in September as the spread of the Delta variant continued to dampen optimism, said Lynn Franco, Senior Director of Economic Indicators at the Conference Board. Concerns about the state of the economy and short-term growth prospects deepened, while spending intentions for homes, autos, and major appliances all retrenched again. Short-term inflation concerns ease somewhat but remain elevated, and consumer confidence is still high by historical levels, enough to support further growth in the near term, but the index has now fallen 19.6 points from the recent peak of 128.9 reached in June. These back-to-back declines suggest consumers have grown more cautious and are likely to curtail spending going forward. Just like what we've seen in the University of Michigan sentiment data in the past 2 months, it looks like consumers are feeling the pain of disappointment caused by the Delta variant of COVID, Jeffries said in a note. Tech was shunned as growth sectors of the market, with earnings that are further out into the future becoming less attractive in a rising rate and inflation environment, where money today is more valuable than money in the future. Apple, Facebook, Google parent Alphabet, Amazon, and Microsoft were all more than 2% lower. And weakness pervaded across most asset classes, including gold, suggesting widespread risk-off sentiment. Gold was down 0.21% to 1,733. Silver was at 22.47, while WT oil was down 1.26% to 74.34. The US dollar index was up 0.36% to 93.72. Bitcoin was down 2.01% to 41,341, while Ethereum was down 3.8% to 2,813. And iron ore finds in Singapore were down 1.06% to 119.17. Now, elsewhere, the world's largest asset manager, Blackrock, has said it's dipping its toes back into the Chinese equity markets following their heavy falls this year, and on bets that Beijing will soon start providing stimulus again. Some of China's biggest stocks are on course for their worst quarter on record following regulatory clampdowns that have hammered supersized tech firms and education providers, and turmoil now engulfing property giant Evergrande. We are tipping a toe in Chinese equities by moving our tactical view from neutral at mid-year to a modest overweight, Blackrock's Investment Institute strategist said in a weekly note just published on Monday. This call is partly rooted in our expectations of incremental near-term easing via 3 policy levers: monetary, fiscal and regulatory, with growth slowdown likely having reached a level that policymakers cannot ignore. The firm added that China's economic growth rate was likely to drop to around 3% in the final 3 months of the year from a stellar 18% in the first quarter. But the more than 30 percentage point underperformance of Chinese equities versus US stocks this year was, quote, overdone, especially with a 6 to 12 month horizon. And it also said the amount of Chinese assets held by clients at the moment was effectively too small, considering the growing clout around the world held by Chinese financial markets. Currently, very small client allocations to Chinese assets would imply a view that China will become essentially uninvestable Blackrock said, adding it had also gone modestly overweight on emerging market local currency debt. Now, more broadly, worldwide energy shortages are threatening to develop into a full-blown crisis, with implications that stretch from Europe to China and to the US. The scenes in the UK over the weekend were reminiscent of the 1970s as drivers lined up at thousands of filling stations amid fears of a fuel shortage, sparked by a lack of truck drivers. But the panic at the pump is really a sideshow. Natural gas prices in Europe and around the world have skyrocketed amid shortages, leading to higher household bills and suppliers collapsing. Shortages of coal and natural gas, similar to those that have hit Europe, are partly behind shortages of electric power in China. Strict emissions targets introduced by Beijing as part of an effort to fight climate change have made matters worse. Local authorities must try to avoid exceeding energy use limits, even as the economy's recovery from the COVID-19 pandemic adds to the demand. Power is so scarce that a number of factories, including some supplying Apple and Tesla, have halted production. Apple component supplier Eslon Precision Engineering and Unicron Technology both said on Sunday that they were halting production until later in the week. And China has pledged to cut energy intensity, a measure of the energy used per unit of economic growth, by 3% in 2021 to meet climate targets. The shortages have begun affecting household use, but the effect on industrial production has prompted analysts to lower their forecast for economic growth. Numera cut its call for full-year growth in China's gross domestic product to 7.7% from 8.2%. And the bank's chief China economist, Lu Ting, said that it could be lowered further. Markets are now so perplexed by the fallout of the property sector that they may ignore Beijing's unprecedented curbs on energy consumption and energy intensity, the economist said in a research note last week. Beijing's unprecedented resolve in enforcing energy consumption limits could result in long-term benefits, but the short-term economic costs are substantial. China International Capital Corp said the shortages could lower the country's growth rate by 0.1 to 0.15 percentage points in the third and fourth quarters, and if the production cuts persist for the rest of the year, Morgan Stanley analysts see a 1 percentage point hit to GDP growth in the fourth quarter. And Goldman Sachs raised its year-end Brent crude price forecast to $90 from $80 and increased its call on WTI to $87. And most notably, the bank's analysts said Hurricane Ida, which battered oil production infrastructure, could prove to be the most bullish hurricane in US history. The global mismatch of demand relative to supply is larger than the bank expected, it said, with the recovery in demand following the impact of the Delta coronavirus variant impact turning out to be faster than anticipated. Throw in the global gas shortage and winter oil demands, and it's finally skewed to the upside, they said. But the bigger question is whether the energy issues and the economic disruption that they now expect to be triggered in China will be more widespread. In any case, for all the talk of a green energy transition, the unfolding events show the economy is still very much powered by traditional fossil fuels. And finally, the Council of Financial Regulators released their minutes from their meeting of last Friday. One item, of course, was housing credit. The minutes read, "The Council continued its dialogue on housing credit conditions and associated risks. Housing credit growth picked up over the first half of the year among both owner-occupiers and investors. The recent lockdowns have reduced transactions and new listings, but prices are still rising briskly in most markets. Commitments for new home loans remain at a high level, suggesting that credit growth is likely to remain relatively strong. The Council is mindful that a period of credit growth materially outpacing growth in household income would add to the medium-term risks facing the economy, notwithstanding that lending standards remain sound. Against this backdrop, the Council discussed possible macro-prudential policy responses. APRA will continue to consult with the Council on the implementation of any particular measure, and over the next couple of months, APRA will also plan to publish an information paper on its framework for implementing macro-prudential policy." So 2 points here. APRA is essentially consulting with itself because they are part of the Council of Financial Regulators alongside APRA, the Treasury and ASIC. And secondly, it doesn't look to me as though anything's going to happen quickly, so there's a lot of waffle around this. The fact is, of course, that lending is continuing to grow, and the Treasury will be very happy about that because basically it's the only growth game in town. Trouble is, the consequences are ever higher house prices, which leads to systemic and structural risk. That is the dilemma they face. It's of their own making. It's unlikely they will do anything to derail that, though, in the short term. So expect a lot of hand-wringing, a lot of waffle, and almost nothing coming out the back in terms of actions. At least that's my view at the moment. New Zealand, of course, is leading the way with some minor tweaks to monetary policy, but even there, house prices are still rocketing away. And it's worth reflecting that around the world, because of the quantitative easing programs that are in place, asset prices continue to bubble higher, and those asset prices include housing costs. So if you really want to address high house prices, you've got to turn off quantitative easing with all the consequences of that. And frankly, I still don't believe that many central banks around the world are going to do that. I think they will continue to print because they have no option but to do so. And that means house prices probably have more momentum ahead, although of course that in turn creates its own problems. Now, if you're buying your home in Sydney's contentious market, you don't need to stand alone. This is the time you need to have Edwin Almeida from Ribbon Property Consultants standing alongside you. Buying a property is both challenging and adversarial. The vendor has a professional on their side. Emotions run high, price discovery and price transparency are hard to find, and then there's the wasted time and financial investments that you make. Edwin understands your needs, so why not engage a licensed professional to stand alongside you? With RPC, you know you have experience, knowledge, and master negotiators looking after your best interests. So shoot Ribbon an email at info@ribbonproperty.com.au, and if you use the promo code DFAWTW/Martin, you can get a 10% discount offer. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.